Good afternoon. My name is Teeroovengadum. I'm the founder CEO of At Africa. For those who don't know who we are a real estate development and investment company. I've got two funding shareholders in my life, being Hyprop and Attack. They're two of the big real estate funds listed on the JSE. And what we do is very simple. We basically develop or buy existing shopping centers across the continent. We're currently present in 3 countries, being Zambia, Nigeria, and Ghana. We own the biggest malls in these countries. So we own Manda Hill in Lusaka, Ikeja Mall in Lagos, and we currently own 3 malls in Accra, including Accra Mall, and we're currently building our 4th mall as we speak in the city of Kumasi. And we're also looking at possibility of doing or buying existing malls in East Africa and potentially in Francophone Africa. So we come from a very different perspective in the sense that we rely on infrastructure provided by government, but also infrastructure being invested by the private sector. I'm happy to talk more about it in terms of the reliability or non-reliability of the existing infrastructure, and then also what we've seen over the last 5 years tangibly in those markets, and also what we think should happen for us to be able to deploy more money into what we do, which is basically building real estate infrastructure on top of your core basic infrastructure.
The next question is for Kevin. As a property developer, and looking at the rapid economic growth and the urbanization and migration patterns in Africa, these have clearly necessitated an urgent need for development of cities and for infrastructure spend. What opportunities do you see existing for institutional investors on the African continent, in particular looking at African cities?
Thank you. I mean, obviously, as I initiated sort of 20 minutes ago, we pretty much the end user, because what we do, we build malls and we own malls in different jurisdictions. So we need good, clean infrastructure in the markets where we go into. Unfortunately, that hasn't been the case. And I'll give you a few examples of the journey that we've gone through. But I think before I go to that sort of micro level, I would rather talk about sort of macro. Because I think, over the last day or so, I've heard a lot, which is good. I've heard a lot about funding being available from the private sector, even from the sovereign wealth funds as well. I think there was a session prior to ours. There's lots of funding being quoted for the continent. But I think one needs to take stock of what's also happening on our continent. So what I mean by taking stock is we've had a fantastic 10 years from 2005 up to 2015. The reason I say this is a lot of the markets where we've invested are markets which were the flavor of the month. There was a consumer thesis that was being sold to global markets. It was a time when places like China was having high growth of around 10%. And it's interesting, I'm going to talk about China relating back to Africa. I spent a week in Beijing 3 weeks ago. And for me, it was an eye-opener. It was also a good takeaway from China, which is also going to impact on our continent. So in what sense? First, I think China have acknowledged that the growth story for them going forward is going to be around 4 to 5%. They've also acknowledged, which is quite interesting, that they've stockpiled sufficient amount of resources for many, many years to come. And the statistics are pretty frightening for somebody who's not in the domain. The statistics goes, they've stockpiled sufficient steel for the next 20 years in the warehouse. So they don't need to buy any additional steel for the next 20 years. Second statistic, they've stockpiled cement, which will allow them to build a 6-lane highway from Earth to Mars. And the reason I'm saying this, I think it's very important I say this, because when in 2014, the oil price dropped from triple digit to double digit, a number of people thought it's going to be just a 6-month or a 1-year blip. And we're already 18 months from 2014, and the oil price is even lower, is hovering around in the range of 40s. So I think, having been on the continent since 1998, I've seen the continent in different phases. And the reason I say the last 10 years has been a fantastic 10 years, I think the issue is what's going to happen in the next 5 to 10 years. My view, I think it's a new norm out there. And the reason I'm saying it's a new norm, and you need to understand in the global perspective, even Christine Lagarde, who is the MD of IMF, came out strongly last week to say, going forward, the world has to adopt a new norm. So what does it mean? A new norm means much lower growth on our continent. So, and this is something which we're already seeing. Take countries where we've invested. Ghana. Ghana used to grow around 7-8%. This year, they're going to be lucky if they're going to strike 3%, 3.5%. In a year where they've got election, when we know when there's election, governments spend far more money than ever. Zambia, same story. The growth has also halved. Nigeria is going for a very, very difficult time as we speak. There isn't a single dollar in the market. We've been trying for the last 6 months to get $10 million out of the banking system. There's nothing, unless you go to the parallel market. But the question is, who's feeding the money in the parallel market? So I think that's why you need to take it in the perspective of what's happening from a macro point of view. So in that macro point of view, also, if you look at what's been happening over the last 5, 6 years, a lot of countries on the continent went on a shopping spree in the Northern Hemisphere, raising huge amount of dollars and on the back of Eurobonds. So countries like Ghana, Nigeria, Cote d'Ivoire, Senegal, Kenya, they all went and raised huge amount of money. Unfortunately, what happened in Mozambique 2 weeks ago with them defaulting just doesn't help. I was in London last week and meeting with investors, they don't care about it's a Mozambican issue. For them, it's an African issue. So it impacts on the fundraising of other countries. So a lot of governments who raise money over the last 5, 6 years have been raising around 5% to 6% from a yield point of view. And when you look at the yields currently, you're talking double digits. So the same governments that had access to $1 billion 3, 4 years ago at 5%, 6% interest rate, now can go to market, can only raise at 11, 12, 13%. So what does it mean? It means basically a revision of investors' appetite and also, I think, a more comprehensiveness of the risk return of the continent. And I'm going to come back to how does this play for us. Yeah. So I think for me, it's going to be interesting to see how much money will be deployed tangibly in infrastructure over the next 5 to 10 years. I'm not skeptical. I'm an African at the end of the day, so I have to be positive about it because it does impact on our business. How does it impact on our business? Just to give you a few case studies. I spent, prior to being the founder CEO of At Africa, I spent around 7 years with Actis. They were the premier private equity funds on the continent. And when we built our first mall in Accra, obviously to build a mall, you need to have good access. You need to have good reliability of power. Unfortunately, we didn't have both. We relied on government to help to expand the road around the mall. And 8 years later, they haven't done it. And we currently had to buy land end of last year, and we'll probably have to do it ourselves. And then when it comes to power, in most of our malls, we actually create our own power. So what happens is we invest additional amount of money, which costs us around 5 to 10% additional on top of your total development costs to produce your own power. So if you go to our mall in Accra, we've got a generator that operates full-time, and we've got 2 backup generators. Typically in your first wall or in South Africa, you'll rely on Eskom, and if it doesn't work, you rely on your backup. There, our backup is our primary generator. That's the reality. Secondly, we built a new mall in the western suburb of Accra, which is called West Hills. That was opened a year and a half ago. And during the construction phase, there was an agreement with government, because it was built on the major highway from central Accra to the western suburb. There was agreement with the government that they would unlock access to our scheme, which unfortunately they didn't do it. We had to spend additional $12 million on top of our $90 million, so that's quite a lot of money on top of our total development costs. And we had to do it ourselves. So where does this lead us? So I think if we're going to keep, and I heard somebody else prior to this panel, I think, talking about the last mile. I think if we're going to keep waiting for government to make it happen, I'm quite skeptical. So I think either the private sector need to take the initiative, or they need to hold the hands of the government and drive the initiative. Then I think it will happen. And the reason I'm saying this, take Nairobi as a classic example. They've opened a ring road from the south of the airport, the Nairobi International Airport, to unlock going to the north of Nairobi, which prevents you from going through the center of Nairobi. Instead of building a three-lane highway, they built a single-lane highway. I don't know how they call it a highway, it's a single lane. 1 year after opening, the traffic that should have taken you 20 minutes from the airport to go to the north takes you 1 hour and a half. Mm-hmm. Yeah. Mm-hmm. The traffic within downtown Nairobi hasn't been solved. It's actually gone worse. I think it's ahead of Lagos, if I'm not mistaken. So I think the issue here is we're always trying to catch up. And myself, from a real estate point of view, I'm frustrated because I'm going to say, when are we going to stop catching up? And when is the private sector going to really sit down with the government and drive this? And I think in maybe my lifetime, which might be 10 years of work life, I think we'll still be catching up because I think there are lots of headwinds coming our way. But having said that, there's far more amount of money as we speak that's been raised. And I think the private sector needs to drive that. I'm not optimistic about the government. We've seen what the Mozambican government have done with the $900 million, which is supposed to be off balance sheet. So a plea to the private sector, including the IFC, who's doing a good job, is please drive that initiative.
Thank you for that, Kevin. So what stands out to me, Kevin, from your discussion is clearly the need for African countries to diversify away from commodities. So it's very clear that you've mentioned China stockpiling, or rather the drop in demand for Chinese imports of iron ore, as well as slowing growth rates that necessitate African governments then to look deeper and say beyond what is there beyond commodities and agri for Africa. Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.